Okay, a little past top of the hour here. Let's go ahead and get started. And I'll start as I typically do with a very sincere thank you, particularly to the attendees. Our participants are tumbling in here. Thanks very much for making the time to join us live on this call this morning or this afternoon, or maybe this evening, depending upon where you are. Also want to thank our panelists. We've got an incredibly broad and deep panel for today's discussion. Their experience, their knowledge. I know it's going to make this a really engaging conversation. I will introduce each briefly in a moment. A couple other thank yous. I want to give a shout out to Brandis Center Advisory Board members Rhonda Berger and Jim Harrington for all their help in organizing and promoting today's event. And lastly, a big thank you to Brandis Investment Partners for sponsoring today's event. If you don't know me, I'm Bob Schmidt, Executive Director of the Brandis Center here at UC San Diego's Rady School of Management. I'll be your host and moderator for today's panel discussion, focusing on private and public equity investing. Now, that's our primary focus, but we may also address other alternative asset classes, such as private credit and real estate. So we'll kind of see where the conversation takes us. And along that line, you as a participant can help guide that conversation. If you have a question for any of our panelists, please use the chat feature or the Q&A. I'll do my best to monitor those during today's webinar. Now, I have to admit, the Brandis Center, we're coming up on our 3-year anniversary. We've done several of these online discussions in the past, and this one has generated more questions prior to the start than any of the others. In fact, maybe all of the others combined. Whether it was you all, when you registered, you had the opportunity to post a question, members of our advisory board, other researchers with whom we work. We've got 29 total questions. So we're not going to get to all of them today. And it tells me a couple things. We've got a really popular topic, and maybe we should have another webinar early part of next year. So look for that in 2026. And these are ongoing conversations anyway. So we've got a lot to talk about. Again, we'll cover as much ground as we can. 2 other notes. We're going to go for 90 minutes today, and this event is being recorded. So next, I think we've got all the table setting out of the way. Next, I want to briefly introduce our panelists. And then after I make the introductions, I will turn things over to them, each of them, to share just in 5 minutes or so, some of the key points that they want to hit during our conversation. So I'll start the introductions with Rachel Farrell. She is Director of Public and Private Markets at UK-based Nest Pensions. Rachel has 30+ years of experience and is both a CFA and CAIA charter holder. She's also a member of the Brandis Center's advisory board. Now, Nest, if you're not familiar, has about $70 billion under management on behalf of 14 million workers in the United Kingdom. So Rachel, thanks very much for joining us from London. Next, I want to introduce Dr. Lisa Larsson. She is partner and leader of the portfolio management team at the StepStone Group. StepStone is a leader in private markets with more than $700 billion in total capital under management. The firm has more than 1,000 employees working from 25 offices around the world. Lisa earned her PhD in applied mathematics from McGill University in Montreal, and Lisa joins us from an office in New York. So thanks very much for being here. And last, Dan Rasmussen, founder and managing partner of Verdad Advisors, an investment firm with over $1 billion in assets under management across multiple asset classes. The firm is based in Boston, and Dan is the author of The Humble Investor, published earlier this year. His research has been featured in the Wall Street Journal, the Financial Times, and Institutional Investor, among others. So Dan, thank you for joining us today. Okay, to get us started, let's turn things over to Rachel for her opening remarks.
Great, thanks, Bob. I'm very happy to be here and to join this interesting discussion. So as you mentioned, Nest is a pension fund. It's a defined contribution plan, and it's called a master trust in the parlance of the UK defined contribution system. And it has, yes, roughly 14 million members and about 75 billion USD of assets under management. 99% of our members default into a target date fund, and the average age of our members is 40, so they have about 25 years left before they retire. And I mention this because I think it is relevant for the way, obviously, we allocate assets and our interest in private markets. So with a 25-year time horizon, private markets fit well into that investment objective, so to speak. So most of our members, as I said, are in the growth stage of accumulation where they can take some risk and they can take some illiquidity. So we currently have about 19% of the portfolio invested across private markets, and that's relatively evenly split between real estate, private credit, infrastructure, renewables, and private equity, though it's a little bit heavier in real estate and infrastructure for some of the diversification benefits there. We do believe we have those allocations to private markets, and in particular private equity, because we do believe that there is an illiquidity premium. We believe there's a complexity premium as well. So we believe, to the extent that our members don't have liquidity needs, there'd be no reason for them to try to take advantage of that illiquidity premium. The other advantage, frankly, that we have is, and we can talk about this a little bit further as we go through the discussion, because these assets are illiquid, they don't price that often. Now, there's some issues with that, but there's also can be an advantage to that, in that one could also believe that public markets don't always price perfectly fairly, price very quickly, sometimes get it wrong, and create a lot of unnecessary volatility in the portfolio. And you get a bit of a pass on that in private markets. So I'm sure we'll talk about that further. The other thing is that, and I think that that Lisa will talk about this, I'm sure, but the construct of capital markets is changing, in that, public markets are shrinking and private markets are growing. And this is partly due to the fact that corporates are seeing the advantage of staying private longer. So we also see that we can have more diversification in the portfolio, to the extent that we can have both public and private. So, as I could say very quickly, that this is not an or, this is an and. We'd want to have both in the portfolio, because they both can provide exposure to slightly different things. So we like the ownership model of private markets. It allows us a more active ownership and potentially certainly we would seek greater transparency. And I say that partly because Nest has a very strong ESG criteria. We think of ourselves, if you think about the fact that we have, 3 out of 10 workers in the United Kingdom are members of Nest, we feel that there is also a responsibility on Nest to be a good corporate actor in the investment community, and to push companies to be good corporate actors in their communities. And we believe the private market has some advantages over the public market in that regard, in terms of influencing the way management takes responsibility for certain things and pushes companies in certain ways, and gives us transparency on what they're doing. And we can talk about that a little bit further later as well. But of course, there are limitations to how much we can have in private markets. We come back to the issue of illiquidity again. Illiquidity, as I said, there is an event, well, you can't liquidate. Now, that's not an issue for us, because we're cash flow positive, and we're cash flow positive for the indefinite future at this point. But on the other hand, you don't want to be fully illiquid in a defined contribution scheme, because we have members coming in and out of the scheme on a daily basis, and the ability to make changes, some changes in their portfolio. Also, this idea of the pricing not being real time. Obviously, we need to price our portfolio on a daily basis, and we'd be uncomfortable having more than, let's say, 30% in private markets. In fact, we have an aspiration to start pushing our allocation from that current sort of 19, maybe to closer to 30 over time. But again, that introduces some pricing lack of visibility on pricing in the portfolio that we're well aware of, and we have some significant procedures in place to help manage that. Also, we're fee constrained. We operate in a fee cap environment. We can't put private markets are more expensive to allocate to than public markets, so that's a constraining feature. And in fact, the bulk of our member population are low to moderate income earners in the UK, and we're frankly quite uncomfortable with some of the compensation structures, let's say, in private markets that don't align well with our member base. So that's something that we are aware of. On the other hand, our scale and the way we invest, which is relatively few managers, large mandates, allows us to negotiate good commercial terms. And then the second thing, because these are quite complex, it also, that scale allows us to resource the team effectively to be able to both select and to monitor those managers. So those are just some opening statements.
Oh, Rachel, that's terrific. I've been taking some notes here. I've got a few follow-up questions for you already. We'll get to that, but let's turn next to, thank you again, Rachel. Let's turn next to Lisa, please.
Thanks, Bob. Yeah, I mean, I would reiterate that private equity, it's a long-term asset class. So, you as a GP, they expect to buy a company, hold it for 5 years, enact a value creation plan, and do something that meaningfully impacts the performance of that company over time. And so, this is not something where you can kind of get in, get out very quickly. And I think to Rachel's point, liquidity is the most important factor that should go into how you size your private equity portfolio or private markets in general. So, I think that if you have kind of a shorter term horizon versus a very long term horizon, you should definitely take that front of mind when sizing a private equity portfolio. The other thing that I want to say is performance has been good. So I think that historically, at StepStone we have an academic advisory council. We work with kind of Steve Kaplan, Tim Jenkinson, et cetera, Greg Brown, top academics who are kind of putting data through the paces to figure out, what does it say? Is there really kind of any value to investing in private equity versus public equity, especially for kind of through the cycle long-term investors? And their answer is yes. So how they look at that is through something called a public market equivalent, which is, I have $1, I put it into private equity, and then, $2 came back. But if I would have put that dollar into the S&P and got $3 back, I would be very unhappy, because that $3 is a lot easier than that $2, to Rachel's point. There's a complexity to investing in private markets. And so you should be able to extract alpha from that investment. And so historically, the median private equity fund outperformed the public market by a margin. So you got alpha. And I think one point that I want to really drive home is that pretty much no one gets into private equity thinking like, yes, I'm going to get the median fund return. And you shouldn't. You should be more disciplined than that. Investing in private markets has a degree of due diligence attached to it. So there is some degree of selection, and there is portfolio construction. So as head of portfolio management, I think portfolio construction is something that you'll hear a lot from me. But having a diversified portfolio of primaries, which is traditional closed-ended funds, but also secondaries, where you kind of enter the fund later after it's started ramping, and co-investments. So co-investments are typically no fee, no carry, or low fee, low carry investments that you can do alongside the GP to reduce your overall fee burden and increase diversification in your portfolio. And so the combination of these three things gives you a more robust portfolio, allows you selection in 3 different directions, and reduces your fee burden, to Rachel's point. So I think that portfolio construction is also top of mind. So if you want to look at the median fund and see, okay, they did really well, that's interesting, you should also be focused on which funds are you going to select, which managers are you going to select, how is that going to help your portfolio, and additionally, what does my portfolio construction look like? Yeah. So I think I would just end by saying that liquidity, liquidity, liquidity. That is the most important factor to determine how to size your private equity portfolio.
Yeah. And as Rachel pointed out, you would think private asset classes are ideal for retirement investors. You know, if you've got that 20, 30-year horizon, having an allocation there kind of makes sense, but I'm getting ahead of myself. Lisa, thank you. We'll get to tons of questions in a moment. Dan, over to you. Any opening thoughts?
Yeah, well, thank you for having me on. I get to play the role of contrarian, so I look forward to taking a beating from the other panelists as we continue, which I think will be fun. We have to start with what is private equity? What are private markets? And so we can start with sizing. So there are about 500 companies in the S&P 500 that account for about 50 trillion of value. There are 2,000 companies in the Russell 2000. Those are about 2 trillion in value. And then there are about 12,000 private equity-backed companies that are about 2 trillion in value as well. So from a market sizing perspective, private equity is about, you call it 4 or 5%. The size of the S&P 500 and around equal to the size of the Russell 2000, but it's comprised of 6 times as many companies as the Russell 2000. So what you're looking at is, first of all, very, very small companies, an asset class comprised of very, very small companies. So when you're buying into private equity, first and foremost, you're buying an immense exposure to the size factor. And what do we know about small companies? Well, broadly, we know that they're more risky, more likely to go bankrupt in a crisis. They're more volatile, they're less diversified, lower margin, et cetera. These are all sort of obvious conclusions that one could come to. If you compare, for example, your local dry cleaner to Facebook or Meta, you should get a sense of the 2 extremes of size. But private equity, of course, is comprised of these very small companies, which by their nature are lower margin, more volatile, and more likely to go bankrupt than large cap companies. The second thing that we can know from a stylized perspective about private equity is its use of leverage. Generally, private equity firms, for every dollar of equity, there's at least $1 of credit, mostly from the private credit market these days. In contrast, public markets have very low amounts of leverage. You know, if you look at the S&P 500, for example, most of the big companies have big cash hoards. So what do we know about companies that use more debt? Well, debt can enhance equity returns, right? Just like if you buy a house, the mortgage. If the value goes up, you can make a multiple as a result of your use of leverage. So in theory, you know, right, if the market goes up 10% and you're, you know, 50-50 debt equity, maybe you should go up 20% in theory. So there's an advantage to using leverage, but there's also a drawback, which is that a little bit of leverage is good, a lot of leverage is bad, and obviously more levered companies are riskier, more likely to go bankrupt. And of course, the interest payments create a major drag on the cash flows of the company, and so, you know, further hurt your margin profile. So you take this asset class, which is, I think, risky, levered, comprised of very small companies. And this was, I think, a very interesting investment when no one else was doing it. And in the 80s and 90s, you could buy these companies for, call it a 40% discount to where public markets traded, which made sense. And then you could sell them to strategics, publicly traded companies in the same industry at a premium valuation. And the people that got into private equity in the early days made an absolute killing doing this. So the track record of private equity for 1980 to 2005 is astonishingly good. But David Swensen and others popularized the asset class, and people in the institutional allocator community took a good idea and went nuts. And so you think of something that's 5% of the equity markets. You know, if you're a 60-40 investor, you should have 3% as your market exposure to it. Large endowments took this up to 40, 45, 50. Pension funds and generally they're in the 15 to 20% range. A massive, massive overallocation to a very high-risk asset class. And as they put more money in over really the last 10 years, that rising tide lifted all boats. So it rose to a peak of 50% of transactions were sponsor to sponsor. As long as the asset class was growing, you could sell at a premium valuation. And illiquid asset classes are very affected by fund flows. But things have reversed, and so it's important to note that we're in a moment of transition. Fundraising is down for the 3rd year in a row. Related to that is that the performance of private equity on a 1, 3, and 5-year basis is worse than public markets. Those endowments that overallocated to public markets private markets are underperforming their peers that didn't. And much of this reckoning is a result of a lack of DPI, distributions to paid in. So typically private equity firms distribute about 30% a year. Recently, they've been about 10% per year. They can't sell their assets. The reason they can't sell them is they paid too high prices. and the amount of leverage is quickly eating away at the equity value. My estimate is about 50% or more of private equity-backed companies are cash flow negative after debt service. So what you see is this changing asset class where the smart money is getting out. Endowments and foundations are saying they're over allocated. They're starting to sell in the secondary market. And now we're seeing a big push to sell this stuff to retail. I have a great faith in the common man, and I think when retail investors say, well, I could put my money in the S&P 500 at 0 fees, or I could pay 4 to 6% per year to lock up my money for 10 to 12 years in private equity and get worse returns in the public markets, I think that they're going to vomit it up. And so I think that we are in a period of where the big correlated belief by everyone in the institutional allocator community that private equity is the best thing since sliced bread is finally changing. And we're going to see the pendulum shift back to its more reasonable attitudes towards private markets.
Okay, Dan, terrific stuff. Let's go back a little bit with Rachel. Just a broader question. When did Nest start investing in private assets? You've mentioned this is managed kind of like a defined benefit plan. So I'm assuming you've been in that asset class for a while, as have other institutional investors around the world.
So Nest has grown quite quickly from a very small base because it was only created about a little over 10 years, and it was created through contributions. So those contributions have been increasing. And so at the start of Nest, there wasn't really the scale to be able to do private markets, and that came more recently. So Nest started its investment in private markets in 2020, which was kind of a good time because it was post the correction in the markets, quite frankly, post around COVID. It started with private credit, then added infrastructure and renewables. Then it always had real estate. Okay, so sorry, I should say that real estate was always part of the portfolio because that's more of a traditional asset class to have. And then added private equity most recently. So the private equity portfolio we've only had for a little under 3 years.
Okay, all right. Maybe it's probably too short of a time to see fees. Have they budged at all? You know, when I look at the amount of assets flowing into private equity and then versus public equity, there's been so much fee compression on the public equity side. I'm kind of wondering, is that going to happen on the private side?
So it is interesting. We've seen fee compression in real estate, in private credit, in infrastructure and renewables, and the toughest one is private equity. But on the other hand, I think you have seen fee compression. It's come slightly differently, which is there's a greater availability of co-invest. And that's a little bit, I mean, Lisa touched on it as a little bit of a way of getting around the fees in the fund, in that if you invest on a co-invest basis, the fees are much lower. So in the fact that most private equity managers are giving a larger allocation to co-invest, in essence, they're lowering fees.
Okay, so I just want to take a little diversion and then come back to some of these other things. Co-investment, again, a guy who spent 30 years in the public equity space before coming to UC San Diego. Co-investment, you're investing along with the general partner, but you have less of that control over influencing the management of the companies. Is that fair?
Well, you're relying on the manager to do that influencing.
Okay.
So you have to pick your manager carefully to make sure you're comfortable with your manager, because no matter what, for an asset owner, in most cases, to the extent that you're working with a general partner who's the manager, you're relying on them. So it's in a sense, it's not really different in co-investment. You're still relying on them. The difference is that you're not investing through a fund where you'd have access to a whole portfolio of companies. When you co-invest, you're doing it typically on a company by company basis.
Okay, terrific. Thank you. Lisa, any thoughts on some of the things that Dan talked about with respect to smaller cap exposure with private equity? Do you see the same things? Is that an issue? How do you handle that? How do you think about that?
I think that, the small cap versus large cap, it's just kind of what you want to add to your portfolio. So again, it's not really an either or. You would never have 100% private markets in your portfolio. It's difficult to manage that. But do you want any at all, or do you need that liquidity, or are you kind of able to harvest a liquidity premium because you have a long-term horizon. I think that's really the question there. And really, I mean, I think that, you know, there is definitely convergence between public and private markets. You know, the global buyout space, I would say, they're doing a good job, but they're getting bigger and bigger. And as you do that, you get closer and closer to looking like the returns that you have in kind of the smaller end of the public market. And so, you know, our historical you know, analysis suggests that one way, you know, I mentioned two things. One is selection and to remain disciplined in your due diligence, and the other is portfolio construction. And I think for selection, one thing is just to kind of try to avoid the fourth quartile. So, you know, if you can just identify even the managers that you think are going to flub it up somehow, that already puts you in a better spot than just getting the median fund return. But portfolio construction and selection is really important, and you know, just diving into the details and getting into the weeds. You know, a GP has done really good at some particular thing, and now he's branching out into something new. Do you believe that that is really the best path forward, and that he has kind of the right expertise there? Or, you know, everybody sees kind of the valuations in the market, especially on the public side. You know, maybe a manager, she decides to do a buy and build strategy, which is not kind of something that she's done historically. So doing that due diligence and understanding kind of how is this particular manager set up, and are they set up for success, and what they're planning to do next is really important as you go forward. And again, avoiding the fourth quartile. You know, there is a lot of research on valuations in private markets because of the artifact that Rachel mentioned. There's this weird thing where you only have 2 transaction dates, when you buy it and when you sell it, and in between it's marked to model. So, you know, you buy a whole company, you hold it for 5 years, you sell it. You had 2 transactions. For Tesla, you have, you know, God knows how many transactions every single day, Bob. So it is a completely different world in terms of valuation. But again, academics have really put that through the paces as well. And what they found is that when GPs try to inflate the valuation of their assets, especially it's tempting when you're fundraising, say like, look, our IRR is really great, please buy our fund. Typically LPs are very good at sussing that out. So the academics find that actually those GPs who are inflating values are very unlikely to raise their next fund. So they're kind of doing this kind of last ditch approach. And in general, I think you'll find that the valuations on the private side tend to be conservative compared to you know, rather than inflating valuations. And one way that we look at that is to just try to understand how a company is valued in the quarters prior to exit. So 3 quarters before it exits, 5 quarters before it exits. Are you on average seeing an uplift prior to the exit, or are you seeing kind of an adjustment to reality? And you know, our research has shown that actually it is an uplift consistently, even over the last 3 years, where, you know, the public markets have really exceeded expectations. I think that, you know, in 2022, they both equities and bonds on the public side had a correction, but in 2023, 2024, you know, the S&P is up 25% plus, and year to date this year it's up 10%. So I think that you know, in terms of performance, you would expect that, you know, if there's some sort of stress in the market, you would have seen it over the last 3 years where GPs had to kind of sell things at a discount because they had marked them too high. But what you're seeing is the opposite. You're still seeing uplift prior to sell, and that gives us comfort around the valuations.
Okay, I want to linger with you a little bit, if I may, because you touched on one question that we got from a lot of people going into this, and I'll get to that in a second. But for StepStone, can you just ballpark it? What percentage of the companies that you hold private equity wise would you characterize as small caps?
So I think everything in private markets is small cap, right? So some people say that the small end of the public market has no analysts, and I would say that that's wrong because GPs are there trying to hunt anything left that's actually interesting. So yeah, no, I would say that the small part of the market that is private equity buyout world.
Okay. And then you touched on the key point that so many people have asked, how do I evaluate a private equity manager? And if I was listening correctly, you're saying avoid the fourth quartile, look for areas where maybe they're getting into new avenues where they don't have expertise, and or look at the valuation of the companies in the portfolio X number of quarters prior to exit. Did I get all of that stuff right? And if not, correct me. And even if I did, what else would you say? What questions, if I'm an institutional investment committee member, what questions should I be asking either prior to investing with private equity or my existing private equity GPs? How do I evaluate these folks?
So I think, unfortunately, there's no one size fits all answer, but generally there's, for a particular GP, they have a strategy. Does that strategy make sense? Have they done well at it before? Are they staffed to execute on it? Are they trying to do something different going forward? Like that, those are basic questions. How do they incentivize their team? Are their past funds doing well enough that their team is going to stay for the next 10 years? This is a very long-term asset class, and you want to know that those relationships are really strong and that they're going to go the distance. So there are an unlimited amount of things that you can dig into with the strategy, for example, and every single one of our due diligences results in different risks and merits. So what are we concerned about with a GP? What do we like? How do we kind of get comfortable with some things that we pointed out to the GP that they say, like, this looks like a red flag or a yellow flag. How do you address that? Those kinds of things. And I think that those are always different. There's no kind of two GPs that are identical in the market, but being able to have teams that actually have known these particular GPs for a long time and have kind of gone through the cycles of, okay, this is your last fund, this is this fund, this is the next fund. You added these people. Okay, we did this co-invest with you. Basically, it's having a holistic picture of how they're creating value and whether you buy that they're going to continue creating value is really important because it's not just about returns in the end. It's oftentimes about the mission. So like there is, for every LP organization, there is someone who's going to either benefit or not benefit from the return of that investment portfolio. And that is a very serious aspect of any kind of investment portfolio. I think that, for Rachel and having kind of, 14 million people relying on this investment portfolio for their pension, that is something that you wake up in the morning and you feel that. It's similar with other institutional investors who pool a lot of different individuals together to have kind of a good outcome long term. And I think that just making sure that you're doing the due diligence and really kind of getting into the weeds with the managers is important. And I know, Rachel, you also had some thoughts about the same topic, so maybe I'll turn it over to you.
Well, hey, we can do that in a moment. I want to jump in. Dan, you've been waiting patiently. Any thoughts on what's been shared thus far?
Yeah, I think there's a wonderful study done by the Oregon Pension Fund maybe 2 or 3 years back, and they've been investing in private equity since the 1980s. Some of they're great LPs in terms of the quality of their due diligence and the length of their time in the market. And this study was really cool because they looked and they studied the entire history of their private equity deployment. And I commend the study to any of you that have time to read it. And one of the interesting things they found is they looked at what first, second, third, fourth quartile, how are their results distributed? And what they found is that they were 20% first quartile, 30% second quartile, 30% third quartile, and 20% fourth quartile. And I think that there's something to that, which is, you can follow the best process in the world, but the minute you start to, the law of large numbers gets to you that, once you start deploying to a certain number of funds, like Oregon has, you end up getting a sort of bell curve shaped distribution. And because so many of the first and fourth quartile funds have some of the same characteristics, they're very small, often first time funds that tend to have sort of these extreme outcomes. And most sort of good LPs are buying into the more established firms. Of course, that's going to further push the bell curve towards the center. So I think that, broadly, if you're investing in private equity as an asset class, you should expect to get asset class-like returns. So I tend to talk about the asset class. Of course, there are people that are exceptional at choosing, and there are people that are exceptional at managing money. So there is a wide variance, of course. But I think one interesting thing to note is Richard Ennis and I just finished a paper, which was a lot of fun. There's a set of private equity funds that are traded on the London Stock Exchange. HarbourVest has a big one. There are a few others. It's not a big number, 10 or 15 of these things, but they've been traded on the LSE back to the 1980s. And so you can look at the performance of these publicly listed private equity funds, and that's exactly what they are. They own a diversified exposure to private equity. And what's interesting when you look at how these funds have done is that they've had about a 1.6 beta, so they've been very volatile, which is what you'd expect. They have underperformed the ACWI largely in the last 3 years because the discount on them has gone from about trading at about 90% 3 years ago, which is right where secondary markets are today, where you try to sell a private equity exposure, maybe get 90 cents in the dollar back. To trading at 70 cents in the dollar. And so there's been a big transition in the way the public markets see private equity. They've really soured on it. There's a lot more skepticism of what is in these private equity portfolios. And so I think that there's been a shift, right? If we were having this panel 3 or 4 years ago, and I was saying some of the things that I was saying about private equity, I think people would say, oh, Dan's amusing, this is funny, let's listen to this nut job criticize private equity, but he's just an unhinged person with an axe to grind. Now people are looking at their returns and saying, wait a second, why am I underperforming? I thought all my alpha was going to come from private markets, and yet the private market exposure has been a drag for 5 years. Why am I paying these crazy fees? Why am I locked up for 12 years? Why can't they sell these assets? The S&P 500 is at all-time high, and they can't sell. What does that say about the assets they own? And I think I think they're right to ask these questions. So I think we're at this moment of transition where I think the critics are starting to look a little bit prescient in terms of some of the problems facing the private equity industry. I'd analogize it to where hedge funds were in 2010 or 2011, where they'd had a really good run. But people were starting to sour on the asset class as the returns looked worse and as people got more and more concerned about the fees.
Yeah. And Dan, earlier you mentioned leverage is a big page in the private equity playbook. How much has rising interest rates over the last X number of years affected that?
Yeah, it's two things. One is so I never like attributing too much to interest rate changes, but I think the rise of private credit has been a big story. So private credit almost didn't exist in 2010. It's risen to be an equal-sized asset class to private equity, roughly. And I tend to think that rapid growths and lending, rapid expansions in lending are always bad, is what history tells us. Markets are efficient. And what you've seen is as these private credit lenders have grown, think of them as sort of the first republic of corporate lenders. You go there and they say, how much money do you want? When do you want it? And what the terms? And they say yes. And if they don't say yes, there's somebody else who just raised a private credit fund that needs to deploy it that will say yes. So there's a race to the bottom on terms. And so as these private lenders emerged, they were willing to lend more and more, often on annual recurring revenue loans where you didn't even have to have profits in order to get a loan. Often these people are lending at 7, 8 times EBITDA. And now the interest rates are probably about 10, 12% on average for these private credit loans. So if you were lending at 8 times EBITDA, 10, 12%, that's 80% plus of your EBITDA is going to debt service. So essentially, these firms just took on too much debt during the peak of the private equity mania. as a result of massive expansion of private credit. And it turns out most of these small companies, these very small companies, just don't have the profits to pay off these levels of loans. And it's a really bad picture under the hood. There are thousands of these companies that are cash flow negative. They've got too much debt. No one can sell them. They're never going to be able to refi. And I think we're facing a lot of pain as a result. So I don't think it's necessarily just the rise in interest rates, although of course that was a big driver. It's that these were irresponsible amounts of leverage. And we've known they were irresponsible amounts of leverage. The Federal Reserve, after the financial crisis, said you shouldn't lend corporates at more than 6x EBITDA. Well, like that's it's, I don't know, 70–80% of private credit is lending above 6x EBITDA. We've known this was bad. But everyone bought into it because private equity could do no wrong. The private equity managers are all geniuses who know how to run companies better than public markets, and they have an aligned ownership. They have a long-term view. All of these, somehow all these, former investment bankers suddenly became the saints of capitalism, and public markets became the villain. And I don't understand it.
Hey, thanks very much, Dan. Maybe Rachel, over to you, or Lisa, if you want to jump in on the cycle of private equity. Because again, if I heard Dan correctly, X number of years ago, private assets, great opportunity. Maybe there's less money sloshing around chasing the best opportunities. Are we at a bit of a peak here on the private side? And should we expect similar returns going forward?
Yeah, I mean, I take all of Dan's comments. I think they're thought-provoking, and I think those questions should always be asked. But on the other hand, there has been this dynamic of a shift. Like if you look at private credit, it's not just that private credit has grown, the banks have exited. So a lot of the, where banks would have traditionally lent post some of the changes in the regulations around banks post GFC have meant that that's not all that interesting for them to do anymore. And that has moved to private credit. So, and in private equity as well. I mean, I think companies are staying private longer. If you look at the stats, and I'm sure Lisa has them right at hand in terms of what we've seen, and I think I could probably pick them up while somebody else was talking, that the reduction in the size of public equity markets during the rise of private equity markets. So, and then obviously there's just global growth as well. So the pie grows at the same time. So, I think, as we talked about this a little bit just offline, I don't think Nest necessarily, Nest is humble enough to think that it won't necessarily always pick the best manager. So I think that we think if we negotiate the right fees, that helps a lot already. So I think that's a big issue. If you are paying full fees in some of these asset classes, you really have to get the best managers because fees eat up so much of the returns. And that's something that's going to have to be addressed when this goes to the retail market. Now, Nest is able to negotiate, very, very attractive fees, and we push very hard and we do certain things because we won't do certain things if the fees are too high. So I think being able to have some leverage on the fees gives us a little bit more wiggle room that we're going to get good managers. And I could talk about some of the things that Lisa talked about in terms of what we look for. Yes, you need to make sure your manager has a sourcing capability, that they're going to have enough things to look at. Then yes, you absolutely have to look at the quality of the team and the motivations of the team that are actually making decisions. Who's making decisions? Are they going to stay around? Do they know how to make those decisions? All of that, you do have to do quite a bit of due diligence on this. You are, as Lisa said, going to be in these investments for a long time. This is still a relatively young portfolio at Nest, as you pointed out, Bob, so maybe we can't quite tell yet, but so far the experience is very good. And again, it's an addition to the portfolio. It's not like, it's the only thing we will do. We're not going to have 40% of our portfolio in private equity alone. As I said, we also have exposure to things like infrastructure, which is important, real estate. So, I think it has a place in the portfolio. Our experience has been good. I do think that it's not the end all, investment. It's not a free pass, and it is getting more crowded. So that does force you to spend a little bit more time understanding who you're investing in. I don't think it's similar to hedge funds, because I think the model of investment is quite different. Hedge funds is a trading activity. private equity, you're actually buying a company and you're able to have levers in order to position that company for better performance. And in that sense, if you're with good private equity managers that are genuinely trying to improve companies and improve economies, it's a very healthy part of, renewing the economy constantly in terms of doing that. So maybe I'll let Lisa add her own comments.
Yeah, no, definitely. I mean, maybe just, taking it in a slightly different direction. I think that another thing that you definitely have to look at when investing in monitoring private assets is the fundamentals. This is not kind of I'm buying it 1 minute and I'm selling it the next asset class, and understanding kind of why a company is marked the way it's marked. Really, you need to kind of dive into the underlying kind of revenue, EBITDA, net debt, et cetera. And so I think that, one thing that we've been looking at over the past 3 years, but even earlier, is, where are companies exiting in terms of their valuation versus where are they held at? So, we did the uplift analysis that said, like, okay, our assets on average getting marked down before they sell, or marked up, they're getting marked up. Well, another canary in the coal mine could be, anything that's being held is marked higher than anything that's selling, because GPs are just scared to take the markdown. And I think the good news is that right now, companies are definitely kind of the holding value and the exit value are matching up. And so that's typically true. I think that in 2023, we saw a gap emerging. So we saw a little bit of a difference between the holding value and the exit value, which caused us to dig in. But essentially, like, the public market, it just has a lot more momentum, a lot more sentiment than what we see in the private market. So GPs, yeah, they see strong operating performance for their company, and they say, no, I'm not going to mark it down just because, the public market is worried for the 100th time that the US government is going to default on their debt. So I think that there are kind of just, and it's an anomaly that is traded by hedge funds, right? So momentum is kind of a known effect on different scales in the public market. But this is something that, when you mark to model, you see less of, right? Like, there is just less kind of urge to say, like, well, I'm going to mark this down by a dramatic amount because there's sentiment in places of the public market. So I think that the punchline there is really that, holding values and exit values are aligned, and, the delta between what we see, public companies being held at and private companies being held at is pretty much similar to the long-term average right now. So if you kind of correct for industry, because IT is always in its own world, you actually see over the long haul that there's about kind of 2.5x difference between, like, an EBITDA multiple in the public market versus an EBITDA multiple in the private market. And that's what we're seeing right now. So in terms of, can companies sell? I think the answer is yes. And, why aren't they selling is a question on everyone's mind. And I think that there's a lot of reluctance. I mean, there's not much happening in the IPO market. That's a great way to kind of exit a company. Corporates, which are another exit path, are reluctant to do much of anything right now because of tariffs. Tariffs are still kind of the macro uncertainty around how everything is going to play out. It makes it just not a great time to say, like, yes, I'm going to buy a smaller company and roll that up into my larger organization. So any of these, like, large capital intensive decisions are being kind of pushed down the road a little bit. You are seeing a lot of GP led. So that basically means that a GP is saying, I have this great asset, I want to keep it for 5 more years and do another value creation plan. I think I can extract a lot more value out of this company by holding it. And I want to selfishly keep it for my LPs instead of selling it to a different GP. and letting them extract that value. And so I think that we've seen a lot of GP-leds in 2024. It was almost 20% of exits happen via GP-leds. And, to the extent that LPs can diligence that new area of the market, it's a good place to, again, add to your portfolio construction, because you have your primaries, they have a certain kind of fee rate. You have secondaries, LP secondaries, which, for our listeners here, typically those have lower fee rates because fees in private markets are charged on invested. So if you invested $100 and now it's marked to 150, your NAV is 150, you're paying fees on 100. So your fee rate is on a blended basis lower in a secondary investment versus your primary. And for co-investment, there's just lower or no fee, no carry. Secondaries, GP-led secondaries, those are also lower fee, lower carry. And so to the extent that, there is a team in place that can diligence those companies and really kind of dive into the details on a single company basis of whether that's a good investment and makes sense, that is definitely a key part of portfolio construction.
Okay. Hey, thanks, everybody. We're past the halfway mark here. At some point, I want to talk about public markets as well, get some thoughts from you there. But one thing, looking ahead for individuals who might be on the call, individual investors, we're not quite there in the States, right? With private equity, private asset exposure in 401k plans, but it's coming. The Trump executive order in August, I know the DOL is looking at some things and supposed to have some comments back in February, but for each of you, what one question would you suggest individuals ask if private assets show up in their 401k at some point? What do I need to know as an individual? I'll just throw it out there. Anybody can jump in.
My advice would be, if private equity shows up in your 401k, find another 401k plan sponsor. I mean, I think that this stuff is not suitable for individual investors. I think when Yale and Harvard are selling, why are you buying? And I think if you look at the experience of these London-listed closed-end funds, it's been really bad. It's underperformed with crazy vol, and you paid super high fees. And I think there are some things in the investment world that are sold, not bought, and private equity being sold into 401k plans, I think, is a perfect example of this. And I think that, one of the challenges here is that I think institutional investors, one of the reasons they love private equity is the volatility laundering. The fact that public markets have a 16% vol, investment grade bonds have an 8% vol. If you look at private equity as it's marked, it has an 8% vol. So you're looking at portfolios of levered microcaps that are mostly cash flow negative, that have a lower volatility than investment grade bonds. And you think, well, that's nuts. Like, these should be more volatile than small caps. And indeed, when you look at the London listed closed end funds, they're much more volatile. They're about 1.6 times as volatile as the public markets. So I think that, broadly, the volatility laundering advantage, which has been good for institutional investors, almost can't apply to these retail, right? The 401k plans, they're going to have to do daily settlement, which means these things are going to have to daily price, which means they're going to look like these London closed-end funds. And I think what's going to happen is, like with any closed-end funds, they're going to start trading at a discount, and that discount will be volatile depending on market sentiment. And I think it's going to be, if London, again, is any indication, public market investors don't like opaque portfolios of random assets that report on, right? It's just hard to understand, hard to process. They trade at a big discount. That's what you see happening. And I think that's what's going to happen when this stuff gets jammed into 401ks.
I mean, I think that retail investors should be very wary of the fees that they pay, and they should get full transparency on fees. And if they're adding private assets to their 401k and the fees are changing, they need to find out. If they're not, and that they have been able to negotiate appropriate fees, it has a place in the portfolio. I do think, I read Dan's paper, and I think it's interesting. But I do think listed structures do perform somewhat differently. And to the extent they're trading at a very large discount, one could argue that maybe that discount is not warranted, that maybe that could be, realized to the extent that they try to unwind them, and that, or maybe it's just a point in time. But I think also, as soon as you list anything, this is the case with REITs and the real estate market as well, as soon as you list it, it looks like public equity. It doesn't, it changes the behavior of the asset class. So there's other things going on there. So I wouldn't necessarily use that as a conclusion to not invest in private markets. I think private equity, if it's done well, and it does give you exposure to a very growing part of the economy, certainly smaller companies are what power growth, in countries, and they're a very important part of the economy. They're a very important part of the investment world, and you want to have some exposure there if done right, diligently. So not in individual portfolios, but in a kind of default strategy. I mean, again, I'm more familiar with the UK market than I am with the US market. I haven't lived in the US for 30 years, so you'll have to excuse me, but there is a way of doing this well. And certainly, as I said before, I do think fees are one area where you can get some transparency and at least can check that. And then, yeah, making sure that it's being done by a institutional quality process, who's managing the 401k. That will be important to understand as well.
Yeah. Lisa, any other thoughts quickly? Because then I want to dive into publics.
Yeah, I think that, the US market is just a strange animal. I think that like in the UK and Australia, there are kind of huge, pension plans and ways that individual kind of workers can get access to just like the combined public-private portfolio and kind of set it and forget it. They don't have to worry about exactly what the asset allocation is. The government worries about that on their behalf. And I think that, in the States, there has been a difference between, there are large public plans, and, they have actually been accessing private markets for decades. And the research indicates that, there's at least 50 basis points of outperformance on those plans versus, your traditional 401ks, just because of their access to private markets. And so I guess one question is just, why should 401ks like not have access just because of, the way that they're structured and so on. And so, to Dan's point, I think that, you should have a choice for sure. If you have kind of a target date fund or a target date fund with private assets, you can go in kind of, with your eyes open. On the other hand, it is going to be kind of the important for kind of the plan sponsor to make sure that kind of the default options make sense and are kind of the best choice performance-wise for, people like you or me who don't actually want to care about, okay, like, should I pick this option or this other option? I just want to retire one day. So I think that there's definitely been some historical outperformance, and there's no access, to private equity within the 401k market currently. And it's great to see that people are kind of sharpening their pencils to figure out how to put it in there. But it is an ongoing debate, which is very uniquely American, because I think a lot of other countries have figured this out already.
All right. Thank you. Hey, switching gears to public markets, the biggest question I've gotten from people is concentration. So this is largely coming from U.S. investors on two fronts. The S&P is, everybody knows, has been concentrated in the Mag 7 for years. And then also, if you look outside the U.S., MSCI World Index, 70% is in the U.S. So how should U.S. investors think about the highly concentrated S&P 500 index? Maybe let's start with that. What if I'm institutional or individual? I don't think it matters. How should I be thinking about this concentrated market?
Yeah, Rob, I think first and foremost, there are certain times in history when exceptional things happen. For classical music, it was Vienna in the 1700s. For the railroad industry, it was the 1800s in England and the United States. And we are living through an age where technology in the United States and Silicon Valley is one of these renaissance moments, right? If you think about Google, Meta, NVIDIA, right? The things that have been invented, the scale of the profits generated. This is sort of a once in 100 years level of innovation that's going on, and it's largely being captured through these large mega cap public equities. And so I think on the one hand, you have to look and say, well, the reason for this concentration is the absolutely exceptional world-changing performance of a very small number of US technology companies that have driven real global innovation and pushed human progress forward. So there's something very wonderful about that. At the same time, those companies are extraordinarily richly valued, as they should be, but also valuations are forward-looking. So on a multiple of past profits, right, they're anticipating continued rapid innovation. And I think even perhaps more concerning, all of those firms are making the same bet, which is on artificial general intelligence. And they're spending massive amounts. So the median tech company used to be about a third as capital intensive as the median industrial company. Today, the large cap Mag 7 names are 3 times as capital intensive as your median industrial company. The scale of the capex is truly astonishing. And I think the number one question for public markets, which again are concentrated now in this one bet, is will that capex pay off? Will AI produce profits commensurate with the massive capex investment? And my argument from history is that the future is very, very hard to predict. And just because you spend money on capex doesn't mean you're going to increase your revenues and profits. There's actually no correlation between capex spending and revenue or profit growth on an industry-wide basis historically. So I do think there are reasons to be concerned as always. But I think for investors with the ability to diversify, none of those are issues internationally. There are no large cap tech companies ex-US, and valuations are relatively attractive ex-US as well. So I think for an investor who's worried about that bet, it's relatively easy to diversify. You just take your US exposure down and overweight international. I don't think I think that's sort of an easy solution. But I do think that so much now about the global market hinges on how the U.S. does, and so much of how the U.S. does hinges on these very small set of companies, and how that very small set of companies does hinges on the one big bet they're all making again, which is AI.
Dan, hang on one second, because I want to go to maybe Rachel next on this whole diversification or concentration notion. But for you, Dan, you mentioned looking outside the U.S. Do you have a region? Developed markets? Are you looking at emerging markets?
Yeah, I'm a believer in property rights, and so I like investing in places that have strong property rights. And as a U.S. investor, having a U.S. Military base in the region is usually a helpful guarantor of my property rights. So I like developed markets. I like places where there are U.S. military bases. And I don't like investing in places that are hostile to the United States or where property rights are not guaranteed, as in socialist economies. So I think, broadly, I like the developed markets outside of the U.S.
Okay, great. Thanks. Rachel, thoughts on market concentration in the U.S. and or investing outside the U.S.? Really curious to get your take, being in the UK.
Yeah, look, we invest in public equity, developed market and emerging market with very little tracking error. And so we're really exposed to something very close to the index. And the index has become very concentrated and very concentrated in the US, quite frankly, as the US has grown. Now, earnings growth in the US is quite a bit better than it is anywhere else in the world. So this idea that somehow you should tilt away from the US into Europe, that has not worked. We've been talking about this for a long time, but that has not delivered better performance in the past 10, 20 years. So you can do that, but you'd have to decide exactly where you're investing. And again, I come back to where in these economies do you want to be investing? And I would say, we do a lot of European private equity because we actually think that's a pretty attractive part of the investment landscape in terms of investing in Europe. So Look, diversification across all different types of asset classes, and Nest is a huge believer in that. That helps us with that that concentration. But it's a concern, and what you're seeing is also you're seeing a lot more sort of co-movements. Like there's less company-specific movements in the market. The market's moving in tandem, so you're just getting this huge, exposure to this monolithic thing now that you used to see a lot more differentiation across these public stock markets. So yeah, it's an issue, and I don't necessarily have a solution other than diversifying, but diversifying across all different types of asset classes. And again, that's why we come back to private markets. Private markets are a very important diversifier. As I said, we're not just invested in private equity, we're invested in infrastructure, in real estate, in private credit, in renewables, in natural capital, we own forests. So, that's the answer, is to try to get as much breadth as possible. And that ultimately coming back to what Lisa was saying about, the way 401k investors have been pretty limited in terms of where they can put their assets, as I understand it, not being an expert at all in the US market. But I agree. I think there is an advantage of having access to a broader set of investment opportunities.
Yeah. Lisa.
Yeah, I mean, I would say that a couple of thoughts. I mean, definitely we also kind of look at the public market and we say, wow, these valuation multiples, especially kind of given the lower valuation multiples we're used to seeing for these private companies, are very, very high. And you have to have pretty strong confidence in the ongoing growth potential of those top few names to get comfortable with that. At the same time, I think anyone in the private market that has a buy and build strategy and has had that for a while is looking at the public market and saying, yeah, keep going. So I think that, to the extent that you can kind of buy things that are very small and successfully integrate them, which is a hard thing to do and requires a lot of diligence, that strategy, you can absolutely make a value arbitrage in either the private market or the public market these days, because I think that that is really something. I think the AI trend in general is very interesting because there are market reports out there that say that margin improvements is like a thing of the past, right? 10 years ago, you could buy a company and they had paper file systems everywhere. You put an HR software system in and you save a lot of money. So just doing kind of basic technology improvements would help kind of the operating margins, significantly. And today that's less common. However, AI does present an interesting opportunity to help operating margins more going forward. So maybe right now there's less of an opportunity, but I think as people start figuring out, GPs in particular, start figuring out how to optimize, how we're using this new technology, that will have an impact on, private equity kind of value creation plans going forward, and absolutely should be part of a due diligence. Are you using this new technology? How are you operationalizing it in your business? I think the other thing is, I don't think any of us wake up and the first thing in the newsfeed is always data centers, data center, data center, data center. And so like this is a plug for infrastructure. I mean, we're talking about private equity, but regardless of how NVIDIA does, these data centers are getting built. And to the extent that you have a potential investment with the right economics on the infrastructure side or real estate side, that could be an attractive way to ride the wave without kind of just blindly investing in kind of NVIDIA and Tesla and so on. But to the other extent, I mean, just because we're in kind of this general, large language model era, doesn't mean we don't need highways. So infrastructure is boring things like toll roads and utilities and so on, and those things we still need. And so, again, diversification, you just have access to a richer set of assets, and that kind of gives you a little bit more a better foundation that hopefully is a little bit more stable in an era of concentration in the public market.
Well, you shared something there that I think is really interesting. If AI can enhance the efficiency of these companies, then the general partners could do part of their job, right? I'm going to buy this company, I'm going to make it more efficient, I'm going to enhance revenue, et cetera, and then have a more valuable company to sell at some point. So maybe that's a great due diligence question for a general partner. You know, maybe the easy money has been made. Tell us how you're really going to improve this business. And then circling back, and maybe I'll pick on Rachel. My knowledge of the UK is pretty limited, but there was something, the Mansion House Accord. Are you familiar with that? Because this notion of infrastructure, and I know we're kind of circling back on private investing, but to me that makes some sense. If there's an opportunity to take assets that are invested within a country and apply them thoughtfully to infrastructure to help within that country, that seems like a good idea. Any thoughts on that? Did I capture that correctly? Is that the plan with
Yeah,
that?
the Mansion House Accord is meant to recognize that developing local assets is good for the economy, and that there should be opportunities for pension funds to invest in private markets as a way of, in fact, supporting the economy. So Nest is a signature to the Mansion House Accord. It's a commitment that, frankly, we already meet today because, as I said, we're ahead of most of the rest of the defined contribution master trusts in the market, but it's a commitment to look to increase investments in private markets, in particular private equity, but also across, as you said, infrastructure and real estate. So I believe the target is 5% across those three areas in UK markets. There was an original Mansion, there was first the Mansion House, I think it was the agreement, and then it became the Mansion House Accord. The Mansion House Agreement required, a 5% specifically in private equity, but that was global, and then they looked to make it more UK specific. So it is the recognition that private markets are actually a very important part of the capital markets and in the growth of economies. So and Nest is very supportive. Our members again reside in the UK. Their ultimate pension pots will depend on their ability to get jobs and contribute to their 401k. The ability to help the UK economy should be amongst the things we look to do. Now, we invest always, with a fiduciary duty to make sure that it is the investment merits itself, but there are plenty of interesting investment opportunities in the UK. So yes, that's what it's designed for.
Okay, terrific. And thank you. I'm falling asleep in my role as moderator, looking at the Q&A. A couple great questions here. One from Juan. Question for Dan, please. Can you comment on the opportunity set in public markets in small caps specifically? The idea was that small caps would at some point become large caps, but now with private companies staying private for longer, what's left in terms of opportunity for listed small caps? Still seeing some opportunity there?
Yeah, so I think you have to think about US and international separately. In the US, there's been a declining number of small cap companies since about 1999, whereas internationally, there's been an increasing number of small cap public companies. So they're different, right? In the internationally, I think you have an expansive public market small cap opportunity. In the US, the small cap market has shrunk. Private equity has actually played very little role in that. Largely, it's been consolidation. Where the attractive small cap companies have been bought by large caps or mid caps. And I think also what you've seen in small cap universe has been some industry concentration where biotech, financials, and energy are quite overrepresented in small cap US equity markets, and other sectors are commensurately less represented. So I think that to your point, I think the small cap opportunity is very vibrant ex-US. It is a little bit less vibrant in the United States, but in terms of aggregate, market cap to GDP or some sort of ratios like that, it's roughly similar to where it was 20 years ago. It hasn't changed all that much, but the number of public companies in the small cap universe has shrunk, and again, largely that's a result of M&A by larger companies. In terms of whether if you want small cap exposure, you need to go into private markets or venture. I think that is an opportunity for those that want to do it, but obviously you have generally a jump in leverage levels and a jump in fee loads and a jump down further in size. There are very few private equity backed companies that are big enough to be in the U.S. small cap index. It's a vanishingly small number. The vast majority would be micro cap or smaller.
And along that line, have you heard of clients, prospects saying, I don't need small cap public exposure because I've got private equity?
Absolutely. Absolutely. I think that the trend has been for people to take their small cap exposure in private markets. In fact, for people to take their public equity exposure in private markets, if you look at the college endowments, for example, the trend, I mean, private equity has been the darling in institutional investors' eyes for 15 years. It's been, everyone wants to talk about, everyone's appointing the new CIO of such and such endowment as the person that used to run privates. I mean, the mania for private markets among institutional allocators cannot be understated. But again, we're going through a detox right now where people are starting to talk about being over allocated, or we're taking a pause on new allocations. We're consolidating to our best managers. It's a sort of 7 stages of grief but we're getting through the first 1 or 2, but there's a lot of cognitive dissonance because if you heard the sales pitch for sort of an OCIO or consultant, it was, we're going to generate all our alpha from private markets, and public markets, we're just owning cheap beta. And all of a sudden that expensive alpha is expensive negative alpha, and that's hard to justify.
Excellent. Thank you. Hey, Lisa, maybe this one for you, a question from Michael. He says maybe not on the menu, but from a private capital perspective, how do you evaluate an allocation to venture cap? I don't think we talked about VC at all, and the startup innovation economy in terms of return opportunity and concentration. So on the VC side, what are you all looking for there?
Yeah, I think that VC is all about access. So again, we have this partnership with an academic advisory council, and a lot of their research suggests that persistence, meaning if the last fund did well, this fund's going to do well, doesn't really exist in the buyout world, but is pretty strong in venture. So if you get into kind of the top decile of managers and you have a really strong relationship with them, in venture, that's a really good sign for your portfolio going forward. I would say that just kind of access to the innovation economy, you can only get it through venture. So that is kind of our world is becoming more and more technology based, especially with the advent of AI. And they are kind of leading the charge. So technology is not just kind of an IT thing anymore. It's a healthcare thing. It's pervasive across all industries, and for all industries to add value going forward, technology is so crucial. And so having innovators thinking through kind of the latest how to solve the latest problems through technology in all aspects of the market, that is venture. And so it's just a question of whether you want to go kind of early stage where things are very new and very proof of concept, or later stage where there's been a little bit more kind of pavement that's been run on, and there might even be some revenue that's generated. So I think that venture is an exciting space, but again, all of these private markets asset classes, it's about kind of your portfolio, your profile as an investor. How much liquidity tolerance do you have? What's your investment horizon? And how much venture should you put in your portfolio?
Yeah. So if I hear you correctly, I've seen these studies on private equity saying larger firms tend to do better, deal access, et cetera, but specific on the VC side, it's not necessarily the size, it's the reputation. So if you've got a firm that's got a reputation for finding the next tech thing, maybe look at those general partners, stick with them, correct?
It's even more than reputation. It's just performance. So, if they've consistently been in the top decile of managers, that is it's not a perfect predictor. To Dan's point, none of us have a crystal ball, but, the academic community has done substantial research to say that there is a very strong signal there. And so access is very important on the venture side.
Okay. 10 minutes left. I want to maybe open a can of worms here with on the public side, active and passive investing. Any thoughts, any concerns about the rise of cap-weighted passive investing?
Yeah, I mean, I think, you know, the SPIVA reports come out every year and they show the percentage of active managers that beat the index across categories. And reliably, the percentage of passive beating active is in the 80s and 90s. So I think the debate is fairly settled in some sense that you know, passive is superior for 80 or 90% of the time. And I think, you know, when you look at persistence, right, we talked about it in venture, private equity, and say mutual funds, there's no persistence in alpha for mutual funds. So if you say, hey, I want to buy the best performing quartile of mutual funds, that they're not going to be the best quartile next year. Just like in private equity, there's no persistence. But as Lisa said, venture is this weird world where somehow there's this like 10% of just like magical venture funds that just consistently churn out amazing returns. And the only question is, can you access them? And then the rest of the asset class is just lottery tickets for rich people. But the public debate, I think, is fairly well settled. And so I think you have to have a very strong case for doing anything active. I mean, it has to be a very, very high bar. And I tend to think that, you know, the percentage that you have in active should never be higher than the percent of active funds that outperform in the SPIVA report. So, you know, maybe you're 80% passive, 20% active, but again, that active has to cross a really high bar to justify the base rates of likelihood of underperformance of the active manager.
Thanks, Dan. Rachel, any thoughts on active passive? How do y'all look at that at Nest?
Yeah, I mean, as I said, we stay pretty close to benchmark. There is this issue of the flood of money going into passive and whether that's sort of a perpetuating thing then. Like how do you know, active managers differentiate stocks, but then if that's not recognized because everything's flowing into passive, then how does that end up ever getting realized? And if we said the statistics are that there's much more co-movement in the market and that stocks don't differentiate, they're all moving in lockstep, it's become incredibly difficult for active managers. So there is this question around, they may be identifying opportunities, but are they able for them to get recognized in the market and the price to be recognized and move? So yeah, it's you know, as I said, we're sticking to something. I mean, we tilt portfolios because, as I said earlier in the conversation, we have very strong ESG criteria. We have you know, we're committed to the net zero transition, and that gives us certain tilts in the portfolio, and that's mostly what we're using that tracking error budget for.
Thanks, Rachel. Lisa, any thoughts? Active passive in the public space?
Well, I think that it's interesting because passive is so pervasive in the public space and it is so difficult in the private space. So, you know, I think one thing that you brought up was, you know, 401k plans, should they have private assets in them in the United States? And I think that might be a big discussion point, just being like, okay, well, you are very kind of comfortable with doing kind of index trackers on the public side, but in private markets, it's actually much easier to have an active portfolio. And so just kind of going from kind of that passive regime to an active regime and understanding those differences is interesting. And honestly, I think that, you know, probably we will figure out how to get more passive on the private side as well the coming years, because I think there will be demand for that. It's just comfortable. You're used to it on the public market side, and you would like to kind of set it and forget it on the private side as well. But, you know, historically, it's been a very kind of roll up your sleeves, do the due diligence, understand how the manager is creating value, and if you buy it, kind of market. And I think that, yeah, it's an interesting discussion.
Lots to look forward to in the future, whether active, passive, private, public, lots of things to keep our eyes on. And like I said earlier, it kind of sets the stage for maybe another webinar on the same topic as it evolves going forward. So Hey, we got about 5 minutes left. I'm getting older. I can't remember the order that I started with. I think, Rachel, I started with you and then I can't remember where I went. Kind of work backwards. Lisa or Dan, any closing thoughts before we wrap things up?
I think I would close with the same thing that I opened with, Bob. So, private equity, it's a long-term asset class. It's buy and hold. So it's not, you don't kind of say, oh, I want to get into private equity. Like I want to kind of speculate on Tesla over the next couple of days. I think maybe it was Charlie Munger who said, we're not stock pickers, we're investors. And so you have to think about it and like, what is the value that's being created and how does it add something to my portfolio? How much liquidity tolerance do I have? What is my investment horizon? And how do I construct a thoughtful portfolio? How do I include primaries, secondaries, and co-investments to get the best kind of fee load on the portfolio, and how do I, select managers that I think are going to have the right kind of diversification, but also decent performance, hopefully better than median, avoid that fourth quartile.
Well said. Thanks, Lisa. Dan, any closing thoughts here?
Yeah, I think that my view is that the private market bubble is popping and deflating, and as that changes and money starts to the big money inflows stop, the asset class is going to continue to experience struggles. And when someone can't sell their assets, it's usually a bad sign, and I think it is a bad sign here. I think that said, private markets are a reasonable size today, right? I mean, again, that maybe it's 3 to 5% of your public equity portfolio or something in terms of the market cap weighted size. And if you're going to do it, I thought Rachel and Lisa had such wonderful points about how to do it. And I think some of the most important ones are to be attentive to fees, to be diversified, to think thoughtfully about the different types of private markets. And I think this is a market where there are a lot of ways you can go wrong very easily, and having that sort of robust institutional process is so important.
Well said. Really well said. Thanks, Dan. Rachel.
Yeah, and with, diversification, you should have a well-diversified portfolio. Private markets have a very important part in a portfolio. They offer diversification. They offer you access to different parts of the economy, different types of companies. We talked about the difference in the companies. You do have to make sure you understand the managers that are doing it, because there is a more active role for that manager to play. But it is important to get access to real estate market, the infrastructure market, the private equity market, because they do get access to different types of companies. They don't look like public markets. They look different. And so for that alone, they have a place in the portfolio. And as Dan said, the endowments did have these extremely large allocations from what he suggested to, so maybe that's not the answer, but they definitely have a place in a portfolio, assuming you have the ability to take on a long-term investment and you don't have any liquidity needs. Because I think if you try to, that's why I'm a little bit skeptical of turning private markets into an index type product, because I think if you create that liquidity, you're going to remove the illiquidity premium. I don't think there's a free lunch here. I think you have to be willing to accept the illiquidity, but if you can, they have a role to play in the portfolio.
That's really interesting. And thank you. Really, really thoughtful comments from each of you, as I expected. Just in closing, one thing I should have mentioned earlier, like you're going to hear a lot of investment advice. Obviously, on the institutional side, talk to a consultant. On the individual side, talk to a thoughtful advisor before you make any investment decisions. Everything's got to be customized for you and your goals. Looking ahead from the Brandis Center side, what we plan to do is post a recording of this to our fledgling YouTube channel that you can find on YouTube at the Brandis Center. And then we'll do a summary of the piece and circulate that as a PDF, put that on the website, and then maybe link to some of the studies that Dan had mentioned. So we've got this comprehensive summary of the conversation. Looking ahead also, later this month, maybe early next, we plan to announce winners in our Brandis Prize contest, which is a prize given to exceptional scholars. This year, they were asked to share some unique research on value investing specifically. So the winners are going to share a $25,000 prize, and then we'll feature their work perhaps in a webinar such as this, or a summary of their work on the site. If you're interested in following the Brandis Center, I encourage you to send us an email. It's brandis@rady.ucsd.edu. And before we officially close, I want to thank again our generous sponsor for today's event. That's Brandis Investment Partners. But also a huge, huge thank you. Lisa, Rachel, Dan, thanks so much. Thanks for being here. Thanks for your candor. Oh, really, really good comments. And with that, I'll say thanks also to our participants for joining us, and we'll sign off. We'll see you again soon, but thanks again, everybody.
Thanks, Bob.
Thank you.
Thank you.